Hey everyone, welcome back to Corporate Decoder. Today we are diving into the thrilling world of share repurchases. Yes, it sounds boring, but trust me, there might be more to this story than meets the eye. We're looking at a filing from Churchill Downs Incorporated, the folks behind the Kentucky Derby and other gambling ventures. They just announced a new $500 million. To break down what that means. Is this a sign of financial strength or something else entirely? Let's find out. First things first, this report is dated March 12, 2025. That's the day they announced this big move. It's called a Form 8K, which companies file to tell investors about important news that could affect their stock price. In this case, it's all about buying back their own shares. So Churchill Downs, the company we're looking at, is based in Kentucky. You probably know them best for the Kentucky Derby. They're publicly traded, meaning anyone can buy their stock, and they use the ticker symbol CHDN. Now, let's get to the main event, the share repurchase program. Basically, the company's board of directors has given the thumbs up to spend up to $500 million to buy back shares of their own stock. Now, why would a company do that? Well, there are a few reasons. Sometimes companies think their stock is undervalued, meaning it's trading for less than it's really worth. Buying back shares can increase the price, making existing shareholders happy. This new $500 million plan isn't completely new money. It's actually replacing an older plan from September 2021, which also authorized $500 million for repurchases. But here's the kicker. They didn't spend all of that money. There was about $6 million left over. So this new program isn't adding $500 million on top of that. It includes that remaining amount. So in effect, it's a renewed authorization of about $30.75 million amount. So in effect, it's a renewed authorization of about $30.75 million amount. So in effect, renewed authorization of about $37 left over. $430 have done $6 million are left over. So this new program isn't adding $500 million on top of that. It includes that remaining amount. So in effect, it's a renewed authorization of about $375 million amount. So in effect, it's a renewed authorization of about $30.75 million amount. So in effect, it's a renewed authorization of about $30.75 million. The company can buy back shares in a few different ways. They can do it on the open market, meaning they just go out and buy shares like any other investor. They can also use something called a 10b5-1 plan, which is a pre-arranged plan that allows them to buy shares even when they have inside information. This helps them avoid accusations of insider trading, or they can negotiate directly with shareholders in private transactions. Here's an important point. This repurchase program doesn't have an expiration date. That means they can keep buying back shares whenever they want, or they can stop at any time. It's entirely up to the company's management. This flexibility is key, as market conditions and the company's financial situation can change. If they suddenly need that money for something else, like an acquisition or to pay down debt, they can simply halt the buybacks. The company announced all this in a press release, which is included as an exhibit in this filing. Press releases are a way for companies to communicate directly with the public and media, so it's worth taking a look to see how they're framing this news. Often you'll find a more positive spin in a press release compared to the dry language of an SEC filing. Now, let's step back and analyze what this all means for Churchill Downs and its investors. Is this a smart move? Well, it depends on a few things. First, is the company's stock actually undervalued? That's a tough question to answer without doing a deep dive into their financials and comparing them to their competitors. If the stock is indeed cheap, then buying back shares could be a good way to create value for shareholders. Second, does the company have the financial strength to afford this repurchase program? $500 million is a lot of money, and it could be used for other things like investing in new growth opportunities or paying down debt. If Churchill Downs is carrying a lot of debt, then using cash for buybacks might not be the wisest move. On the other hand, if they have plenty of cash on hand and strong earnings, then a repurchase program could be a good way to return capital to shareholders. Third, what are the alternatives? Could the company use this money to make an acquisition that would boost their earnings even more? Or are there other investments they could make that would generate a higher return? These are the kinds of questions that investors should be asking themselves when evaluating a share repurchase program. It's also worth noting that share repurchases can sometimes be a way for companies to artificially inflate their earnings per share. By reducing the number of shares outstanding, they can make it look like their profits are growing faster than they really are. This can be a controversial practice as it doesn't necessarily create any real value for the company or its shareholders. Looking at Churchill Downs specifically, they operate in a pretty competitive industry. They face competition from other casinos, racetracks, and online gambling companies. So they need to be smart about how they allocate their capital. They need to invest in their existing businesses, explore new growth opportunities, and manage their debt levels. A share repurchase program can be part of that strategy, but it shouldn't be the only focus. Overall, this share repurchase program is a mixed bag. On the one hand, it could be a sign that Churchill Downs believes its stock is undervalued and that it's committed to returning capital to shareholders. On the other hand, it could be a way to artificially boost earnings per share or to distract from other challenges facing the company. Investors should do their own research and consider all the factors before making a decision about whether to buy, sell, or hold Churchill Downs stock. Don't just take the company's word for it. Dig into the financials, analyze the competition, and assess the overall risks and opportunities. Ultimately, the success of this share repurchase program will depend on how well Churchill Downs executes its overall business strategy. If they can continue to grow their earnings, manage their debt, and make smart investments, then the buybacks could be a good way to enhance shareholder value. But if they stumble, the buybacks could end up being a waste of money. Thanks for watching. If you enjoyed this video, please give it a like, leave a comment, and subscribe to our channel for more in-depth analysis of corporate filings. Until next time, stay informed and invest wisely.